Your gold didn't just dip, it collapsed. Your silver didn't correct as it was obliterated. Red screens, margin calls, panic everywhere. But while retail investors were staring at losses, something else was happening completely off screen. Quiet, precise, relentless. China moved $634 billion, and almost nobody noticed. Not rumors, not speculation. Documented, filed, buried inside U.S. Treasury data. By the end of this breakdown, you will see exactly where that money went, what China is constructing with it, and why the crash you just witnessed may not matter at all. Once the dots connect, there is no going back. Welcome to the part of the financial system you were never meant to see. For most investors, the last crash felt final. Gold dropped over 20%. Silver was crushed by more than 40%. Commentators rushed to declare the cycle dead. Headlines screamed bubble, exhaustion, end of the trade. And that reaction makes sense, because the modern financial system has trained people to believe that price is truth. If the screen turns red, the story must be over. If momentum breaks, fundamentals must be gone. But here's the problem. Markets today are not driven purely by supply and demand. They are driven by leverage, paper contracts, margin rules, and forced liquidation. When pressure hits the paper side of the system, prices collapse regardless of reality. And while retail investors react emotionally, governments and central banks operate on a completely different time horizon. They do not trade weeks or quarters, they position for decades. That disconnect is where most people get hurt. Because what happened during the crash was not a reversal of fundamentals. It was a liquidity event. Paper claims imploded. Physical demand did not. Yet almost no one asked the most important question of all. If $634 billion left U.S. treasuries, where did it actually go? Money does not vanish. It migrates. And when that much capital moves quietly, deliberately, and repeatedly, it is never accidental. It signals a structural shift, one that rarely shows up on price charts until it is too late. The mainstream financial media focused on charts, technicals, and short-term sentiment. They ignored filings. They ignored inventory data. They ignored central bank balance sheets. And by doing so, they missed the largest coordinated financial strategy executed by any nation in modern history. Gold crashing didn't mean the story ended. It meant the real story was happening somewhere else. What if the crash was the signal to sell? But the signal that something massive was already in motion. What if a gold falling 21% didn't mean weakness, but camouflage? Here is the uncomfortable truth. Not a single major Wall Street bank turned bearish after the crash. Think about that. JP Morgan raised its gold target. Deutsche Bank held firm at record levels. Citi increased its silver forecast. Morgan Stanley told clients to allocate 20% of their entire portfolio to gold, something that bank has never done in its history. That should stop you cold. Banks do not make those calls emotionally. They do not do it for headlines. They do it when the data forces their hand. So what are they seeing that most investors are not? They are following the same trail I followed. A trail that starts in Washington, winds through Beijing, passes through vaults, payment systems, commodity exchanges, and central bank balance sheets. And hidden inside that trail is a number so distorted, so extreme, that it permanently changes how you view silver once you understand it. But before we get there, you need to see the full strategy. Not fragments, not just gold buying, not just silver controls, not just currencies. 7 pieces, all live, all connected. This is not theory, this is execution. And once you see how these pieces interlock, gold, silver, trade settlement, payment systems, digital currency, debt conversion, and state doctrine, you will understand why the recent crash may be remembered not as an ending, but as an intermission. The real story does not start with the crash. It starts years earlier, hidden inside balance sheets, trade flows, and filings that almost nobody reads. In 2013, China was the single largest foreign holder of U.S. Treasury debt on the planet. More than $1.2 trillion of American government bonds sat on China's books. That position gave China safety, liquidity, and access to the dollar system, but it also created a vulnerability few people understood at the time. Because when your reserves sit inside someone else's system, they are not truly yours. That lesson became painfully clear in 2022 when hundreds of billions of dollars belonging to another sovereign nation were frozen overnight. No war declaration, no court ruling, just a policy decision. Assets gone. China noticed, and instead of reacting loudly, it responded quietly. Year after year, China began reducing its exposure to U.S. treasuries. Not dumping, not panicking, just steadily selling. The numbers barely made headlines. 50 billion here, 100 billion there. Slow enough to avoid shock, fast enough to matter. By the time most people realized what was happening, over $634 billion had been removed from U.S. government debt. That is not a rebalance. That is an intentional unwind of financial dependence. And money of that size does not sit in cash. It moves with purpose. The first destination was gold. Month after month, the People's Bank of China added to its gold reserves. Not opportunistically, not tactically, relentlessly. Prices rose, China bought, prices pulled back, China bought. Even during one of the strongest annual rallies in modern gold history, buying never stopped. That behavior tells you everything. This was not a trade designed to make money next quarter. This was a national strategy designed to reshape reserves over decades. Official data shows China's reported gold holdings climbing steadily, but even those numbers are widely considered incomplete. Analysts have long pointed out that China often acquires gold through state-owned banks that do not report purchases to international organizations. What you see is likely the minimum, not the total. But the most important number is not how much gold China has. It is how little gold represents within China's reserves. Roughly 8.5%. Compare that to the United States and Europe, where gold typically makes up 60 to 70% of reserves. Even Russia, after years of aggressive accumulation, sits around 30%. If China wanted to reach even that level, not Western levels, just Russia's, it would require thousands of additional tons of gold. At today's prices, that implies hundreds of billions, potentially over $1 trillion of future demand that has not yet occurred. This reframes everything. The crash did not mean China stopped buying. It meant China had barely started, and China is not alone. Since 2022, central banks worldwide have been buying gold at a pace never seen before, more than 1,000 tons per year, multiple years in a row. This exceeds demand during periods of war, crisis, and monetary collapse. Central banks do not chase momentum, they respond to risk. Gold is not an investment for them, it is insurance. Silver, however, tells a different but equally important story. Unlike gold, silver is not primarily a monetary metal anymore. It is an industrial one, and that makes its supply dynamics brutal. For 5 consecutive years, the silver market has run a deficit. Hundreds of millions of ounces consumed beyond what mines produce. That silver did not go into vaults. It went into solar panels, electric vehicles, electronics, medical equipment, and data centers. Once silver is embedded into technology at scale, it is effectively gone. Mining cannot respond quickly. Most silver is produced as a byproduct of other metals. You cannot simply open a new silver mine because price went up. From discovery to production takes a decade or more. So while demand grows exponentially, supply inches forward. Inventory reveals the strain. Registered silver stocks across major exchanges have collapsed since 2020. Vaults in North America, Europe, and Asia are all drawing down simultaneously. This is not a regional issue. It is systemic. And then there is the paper market. On major exchanges, the number of paper claims on silver dwarfs the amount of physical metal available for delivery. The system works only as long as almost no one asks for the real thing. It is stable until it isn't. When volatility hits, paper collapses faster than physical reality. That is why silver falls harder during crashes, and why it rebounds more violently when pressure releases. Now add China's export controls into this environment. A significant share of global silver supply is now restricted. Not eliminated, restricted. That matters because it tightens availability exactly when inventories are already thin. Gold is the reserve. Silver is the pressure point. But metals are only part of the story. Because while China was buying gold and locking down silver, it was also building infrastructure, financial infrastructure, payment systems, settlement networks, trade routes that bypass traditional choke points. This is where most people lose the plot. Currencies do not dominate the world by strength alone. They dominate by plumbing, by being unavoidable, by being the default path money must travel. For decades, the dollar system had no serious alternative. Now it does. China built parallel systems designed to move money outside the dollar framework. At first, adoption was small. Then it accelerated. Banks joined, countries joined, trade followed. At the same time, China expanded digital settlement platforms, partnered with commodity exporters, and encouraged trade invoicing in its own currency. The effect is gradual, not dramatic. But gradual does not mean insignificant. Every transaction that bypasses the dollar reduces structural demand for it, not temporarily, permanently. This is not about collapse. It is about erosion. And in an eroding system, hard assets regain strategic importance. Gold benefits because it is neutral. Silver benefits because it is scarce and essential. The crash did not invalidate this story. It exposed the difference between paper mechanics and physical reality. What broke was leverage. What remained intact was demand. And that is why the institutions that matter did not turn bearish when prices fell. They were not looking at the screen. They were looking at the structure. The story is not over. It is unfolding, quietly, methodically, and mostly out of sight. This is the point where all the scattered pieces finally lock together. Up until now, gold buying looks like reserve management. Silver controls look like industrial policy. Treasury selling looks like diversification. On their own, each move can be explained away. Together, they form something much bigger. China is not reacting to markets. It is redesigning its position inside the global financial system. Gold is the foundation of that redesign. For decades, the US dollar dominated not because it was perfect, but because it was unavoidable. Trade settled in dollars. Debt was issued in dollars. Payments flowed through dollar-based systems. Even countries that distrusted the United States still had to use its currency. That dependence is the real risk China is hedging against. Gold removes counterparty risk. It cannot be frozen, sanctioned, or canceled by policy. That is why China is buying regardless of price. Price volatility is irrelevant when the objective is sovereignty. But gold alone does not solve the problem. You still need a way to move money. That is where China's parallel payment infrastructure comes in. China built its own cross-border settlement network, an alternative route for international transactions that does not require the dollar system. Adoption started small, then quietly accelerated. Thousands of banks across more than 100 countries are now connected. This is not about replacing the dollar overnight. It is about creating a second option. Once a second option exists, monopoly power disappears. Countries no longer need permission to trade. They no longer need to route transactions through a single financial highway. And once those routes are established, they do not vanish during the next crisis. They expand. Then comes digital settlement. China pushed beyond traditional banking rails into direct digital currency platforms designed for cross-border trade. These systems are faster, cheaper, and programmable. More importantly, they allow settlement outside Western-controlled infrastructure. And look at who is participating. Energy exporters, trade hubs, financial centers. This is not symbolic participation. It is functional. It is live. And it signals something profound. Major commodity producers are experimenting with settlement systems that do not rely on the dollar. That alone changes long-term demand dynamics. Now add trade settlement. Roughly 1/3 of China's trade is already settled in its own currency. 10 years ago, that number was close to zero. That shift happened without a crisis, without headlines, and without a currency collapse. Every percentage point that moves away from the dollar is permanent. Those flows do not automatically return. Debt conversion takes this one step further. When a country owes debt in dollars, it must earn dollars. It trades in dollars. It stays tied to dollar infrastructure. But when that debt is converted into another currency, the entire incentive structure changes. Trade realigns, payment systems shift, financial gravity moves. One conversion does not break the system. Dozens of conversions quietly thin it. And finally, the strategy is no longer implicit, it is explicit. China has publicly defined currency strength as a component of national power. This is not rhetoric. It is policy embedded into multi-year economic planning. That means gold accumulation, settlement infrastructure, and trade realignment are not temporary responses. They are long-term objectives. Now here is the crucial clarification. This does not mean the dollar is collapsing tomorrow. The dollar remains dominant. It is still the primary reserve currency. In moments of crisis, global capital still runs toward it. But dominance is not the same as monopoly. The dollar's share of global reserves has declined steadily over decades, not violently, gradually. That is how reserve systems change. And in that slow transition, gold benefits regardless of who wins. If the dollar remains dominant, gold preserves credibility. If the system becomes multipolar, gold becomes neutral ground. Silver benefits differently. Silver sits at the intersection of monetary stress and industrial necessity. It is both a financial pressure valve and a physical input that modern technology cannot function without. That combination is rare and dangerous for a system built on paper leverage. This is why the crash did not invalidate the metal story. It revealed the difference between paper pricing and physical reality. What broke was leverage. What remained was strategy. And once you see that, you understand why the biggest players stayed bullish after the fall. They are not trading a chart. They are positioning for a structural shift. And that shift is already in motion. Now, let me be straight with you. None of this is easy. None of this is smooth. And none of this guarantees painless returns. Gold and silver are volatile because they exist outside the comfort of financial engineering. They do not promise stability. They expose reality. Silver especially is brutal. It will test patience. It will test conviction. It will test emotional discipline. If a 40% drawdown feels unbearable, silver will break you long before it rewards you. But volatility does not equal weakness. Every major metals bull market in history included violent shakeouts designed to remove weak hands before the next leg higher. This is not advice. This is perspective. What matters is not what happened on one Friday, but whether the underlying forces changed. And based on the data, they did not. Central banks didn't stop buying. Deficits didn't close. Export controls didn't lift. Payment systems didn't reverse. The story continued, just quietly. Remember how this started? $634 billion vanished from U.S. treasuries. Now you know where it went. Now you know what is being built with it. Now you know why gold and silver behave the way they do. This was never about a trade. It was about positioning for a world where no single currency dominates uncontested. China isn't attacking the dollar. China is building an exit, and that exit is paved with gold. If history teaches us anything, it's this. Every time people declare gold finished, the next chapter is already being written somewhere else. The crash wasn't the ending, it was the intermission. If this breakdown helped you see the bigger picture, share it with one person who still thinks price is the whole story. Most people never look past the screen. And next time, we'll dive into how major institutions positioned themselves at the exact bottom of this crash. Filings, timing, and all. Drop your gold and silver targets for the next cycle below. I read every single one. I'll see you in the next breakdown.